Ladies and gentlemen, good day and welcome to Zensar Technologies Limited Q2 FY23 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mukul Garg from Motilal Oswal Financial Services Limited. Thank you and over to you, Mr. Garg.
Thank you, Nirav. Good morning, everyone. On behalf of Motilal Oswal Financial Services, I welcome you all to Zensar's Q2 FY23 earnings call. We have with us today Mr. Ajay Bhutoria, CEO and Managing Director of Zensar Technologies, Mr. Sachin Jute, CFO, and other senior management team members. Before I hand over the floor to Ajay, I would like to highlight that the safe harbor statement on the second slide of the analyst presentation is assumed to be read and understood. With this, Ajay, over to you.
Thank you, Mukul. Good morning, good afternoon, and good evening, everyone. Thank you for taking the time today to discuss Zensar's financial results for the second quarter of FY23. With me on the call are a few others from the Zensar leadership team. Sachin Jute, our Chief Financial Officer, Pramila Kalive, Chief Operating Officer, Vivek Ranjan, our Chief Human Relations Officer, Harjot Attri, Global Head of High Tech and Manufacturing, Sameer Gosavi, Global Head of Consumer Services, Nachiketa Mitra, Global Head of Financial Services, Manikandesh Venkatachalam, Global Head for Markets for Service Lines, and Ankush Akar, Global Financial Controller. The second quarter of FY23 stood steady for us with revenue of 155 million, representing quarterly year-on-year growth of 14.4% and a sequential quarter-on-quarter growth of 1.6% in constant currency. In reported currency terms, we registered quarterly year-on-year growth of 9.3% and a sequential Q-on-Q decline of 0.5%. Before we go through individual business level performances, let me spend some time on the trends we see in the global market and IT industry today. There has been a deceleration in the demand environment driven by softness in global macro factors, which is also reflected in broader market indices. As such, we have seen margin pressures across companies, including the Fortune 2000. In this environment, we have seen a segment of our clients, particularly in the HTM and CS verticals, deferring or optimizing their discretionary spend and scaling back their budgets. That said, let me walk you through the performance of our geographies and verticals for the quarter. All growth numbers are in constant currency. The US region registered quarterly year-on-year growth of 11.1% and a muted sequential quarter-on-quarter growth of 0.4%. We continue to show growth in this region aided by momentum in the BFSI vertical, which helped offset headwinds in HTM and consumer services verticals. We registered modest growth in Europe with quarterly year-on-year growth of 25.9% and a sequential quarter-on-quarter growth of 1.7%. We have witnessed good deal wins, especially with existing clients in this region, despite global uncertainties. The South Africa region too continued its growth momentum with quarterly year-on-year growth of 16.4% and a sequential quarter-on-quarter growth of 9.1%. We continue to have positive traction in this region for our offerings in cloud, data, and advanced engineering services, resulting in ramp up with some of our key banking and retail clients. Moving to our verticals, BFSI continued its growth trajectory with a quarterly year-on-year growth of 33.8% and a sequential quarter-on-quarter growth of 6.1%. We are witnessing good traction in this vertical from both long-standing and new clients. Over the last few quarters, we have added marquee new logos, including from the Fortune 500 group, which enables significant headroom for growth. We are scaling these accounts through our verticalized offerings, as well as through advanced engineering and data services. In Q2 FY23, growth has been flat for HTM and emerging vertical, with a quarterly year-on-year growth of 6.5% and a sequential quarter-on-quarter growth of 0.1%. Our consumer services vertical registered quarterly year-on-year growth of 5% and a sequential quarter-on-quarter decline of 2.5%. As I noted earlier, we anticipated a slowdown in growth along these two verticals. To negate the impact, we continue to drive our efforts with targeted industry-aligned solutions while also strengthening our go-to-market initiatives and focus on existing and newly opened accounts. Our gross margin stood at 25.3% in Q2 FY23, representing a sequential quarter-on-quarter decline of 120 basis points. Our EBITDA stood at 8.5%, a sequential quarter-on-quarter decline of 270 basis points. We ended the quarter with a net cash position of $162.1 million. The order book for Q2 FY23 stood at $141.8 million, supported by multiple wins across verticals and a healthy mix of new wins and renewals. For the second quarter, our last 12-month attrition stood at 26.3%. Our in-quarter attrition trend has seen significant improvement by more than 450 basis points. This quarter, we gave one of the largest salary increases in our recent history, which has been well received by our associates across all levels. Our global headcount at the end of Q2 FY23 stood at 11,250 associates. The momentum in our fresher program remains strong. We onboarded more than 1,200 freshers in the second half of FY22 and another 400 in the first half of FY23, which has reduced our dependency on lateral hiring. Our clients have responded positively to this program, which is a credit to our new expansive learning and development program and our robust gating process. In all, we have seen both an uptick in fresher deployment and improvement in our pyramid. Our service lines continue to scale up and deliver targeted solutions for our clients. Overall, we have seen a rise in multi-service line deals this quarter. Our focus service lines, advanced engineering services and data engineering, registered 7.4% and 16.8% sequential quarter-on-quarter growth respectively. We are witnessing notable movement in our digital engineering services with multiple wins in cloud migration, cloud modernization, and enterprise transformation. Likewise, our data engineering services are experiencing a similar ascent with strong revenue growth and multiple industry recognitions in recent quarters. As always, I am excited to speak about the work we do for our clients. We continue to deliver value through integrated solutions encompassing multiple capabilities and service lines. Let me take a few minutes to share some examples of our high-impact work. We partnered with a major American insurance provider for modernization of their data warehouse using cloud-native data services. This re-architected platform helped the client reduce the reporting efforts for policies, billing, and claims, thus optimizing their support and maintenance costs. We were selected as a partner by a specialist investment management firm to provide application development services. We followed a design-led approach for digital engineering, which helped in industrialization of development practices across the company. We worked with a US-based omni-channel retailer to modernize their enterprise platform and partnered for the company's POS transformation program. This has helped the company achieve stability, scalability, and higher resiliency in its applications. In the cloud and data engineering space, we work on the AWS migration of serverless workloads for a leading oil and gas company. A leading South African bank partnered with us for their product suite modernization. The scope of work included consolidating 15 lending applications on a new common platform, which helped the client rationalize its application portfolio, leading to reduction of cost and effort. We were selected as a strategic partner by a global air logistics leader for its application management and platform modernization initiative. Our cloud-first total experience approach is helping the client run the business and modernize these systems with minimal disruption. We continue to make strides in our sustainability journey in line with our published ESG vision and mission. We have successfully launched phase 2 of our official sustainability microsite, and it is now readily available to our stakeholders. In support of World Health Day 2022, we aligned with the World Health Federation's month-long campaign, communicating both internally and externally for the benefit of our associates globally. We also participated in various forums, including the 15th edition of Environment and Energy Conclave and the Asia Pacific CEO Roundtable hosted by the UN, GCNI, and SAP, where we presented the ESG best practices at Zensar. In closing, our order book has steadily increased despite global uncertainties. We continue to invest in our freshers program for better control of our supply chain. On the margin front, we are working with utmost discipline and diligence. We are focused on the 6 identified margin levers to drive meaningful improvement in the medium term, while also ensuring a healthy allocation for growth. While we continue to navigate macro-induced headwinds, we are certain that secular long-term growth in the IT industry will not diminish, as digital transformation and tech spending have become core to the client journeys towards long-term growth. In the past year, the changes we have made to sharpen our services, improve our go-to-market, and invest in our talent have yielded significant results. We are confident that Zensar is emerging stronger as the preferred go-to partner for our clients worldwide. With that, I will now invite Sachin Zute, our Chief Financial Officer, to provide an update on critical financial data, after which we will open the floor for questions.
Thank you, Ajay. Good day, everyone. Welcome to this call. In addition to Ajay talking about business, I'll take you through some key financial metrics. In US dollar terms, the company reported a revenue of $155 million for the second quarter of FY23, reflecting decline of 0.5% sequentially and growth of 9.3% year-on-year. In constant currency terms, however, revenue growth for the quarter is 1.6% sequentially and 14.4% year-on-year. The US dollar realization during the quarter has been 79.6 per dollar against 77.1 in the previous quarter. Our gross margin for the quarter stood at 25.3%, 120 basis points lower than previous quarter, and EBITDA stood at 8.5%, 270 basis points lower than previous quarter. Decline in EBITDA was primarily due to wage hike impact of 320 basis points and negative impact due to overall currency movement of 20 basis points. The benefit of 3.1% USD INR depreciation was negated by other cross-currency movements where GBP and ZAR depreciated by 6.3% and 8.5% respectively. In line with what we shared in annual investor conference last month, we continue to drive disciplined program for margin improvement through measures such as increasing fresher deployment, improving commercials, optimizing operational metrics, and rationalizing costs. This has helped us to partially mitigate the impact of wage hike in the current quarter. Given the steps taken, we believe that we have bottomed out on margins and expect to see improvements from current levels. At the same time, we continue to focus on achieving our long-term objective of predictable growth by making growth-driven investments into the business. For the quarter ended September 30th, 2022, DSO, including unbilled, stood at 80 days, as against 83 days in previous quarter. For the quarter, cash and cash equivalents, including investments in mutual fund, stood at 162.1 million, post-dividend payout of 9.7 million, and annual variable payout for FY22. The effective tax rate for the company has remained flat at 26.3% against the previous quarter. With that, I come to end of my presentation and I open the house for the questions. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity. My question was on the margins. I mean, we have seen margins going down 300 basis points QOQ. I mean, we understand that you had indicated about the large wage hike that you had given. But I mean, just wanted to understand what is the thought process now, because, when we see the situation currently, I mean, the demand environment is looking weak as per your commentaries. And despite that, we are giving one of the large wage hikes. So, I mean, how are you seeing the situation now? And your guidance of mid-teens kind of a margins, which was there in by second quarter of second quarter of FY24. I mean, it becomes really difficult to understand as to how you will be able to achieve that, given now at least demand is slowing down and we are having a utilization which is 80%. So just wanted to understand what is your thought on that.
Sure. So, I'm not sure this is Mihir, right?
Yeah, yes.
Yeah, Mihir. So, Mihir, thank you for the question. So let me start by saying that, we have bottomed out on margins. Now, if you see what happened, what led to this situation was largely driven by unprecedented attrition that we suffered and a huge dependence that we as a company had for lateral hiring to drive growth that we saw over the last 6 quarters, right? We have put very significant measures in place, starting with a very expansive freshers program. In addition, we are running a very disciplined ship to improve margins across 6 levers that Sachin mentioned, right? So improved service mix, improved commercials, improved utilization, optimized pyramid, optimized support costs, and optimized cost of talent acquisition. The way we are running this ship, the way we are enforcing the discipline, right? And even after factoring what we see is softness in some segments of our business, we are sanguine that we will achieve our, stated objectives of margin targets. And like I said, we are firmly of belief that we have bottomed out this quarter and that we see margins steadily improve from this point onwards. Sachin, would you like to add?
Absolutely, Ajay. What you said, there are 6 programs which we are internally running, and we have started seeing initial success of each of these programs, Mihir. And in spite of the softer environment which you referred to, we believe that the discipline and the rigor which we have put in the organization will help us to improve our margins from Q2 levels.
Sure, yeah. And just one question on the demand side. I mean, if you could go some more highlight as per the verticals. Consumer services is facing pressure. I mean, should we see similar kind of pressures continuing at least for this year and next year as well?
Yeah. So we see segments, because of what's happening with the macroeconomy, we see segments of softness. And this softness is hitting us on two fronts. One is within our STM and consumer services vertical. And also, a large part of this is resulting in reduction of discretionary spend from certain segments of our clients. So our service line, which caters to a lot of this discretionary spend, which is experience and our design services, has also suffered headwinds because of that. We foresee in the short term these headwinds to continue. We also believe that the long-term secular demand trajectory will go up. So in the short term, the headwinds will persist, but in the medium and long term, the secular demand scenario will continue to look upwards and will then assist the growth of consumer services and also segments of our high-tech manufacturing vertical.
Sure, yeah, that's it from my side. Thank you.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Yeah, thank you. I just wanted to follow up, on the query about STM and consumer. What's your outlook, for both of them in the near term? You usually have a fairly pronounced furlough impact in Q3. Is that something which we should anticipate this year as well, given the kind of preemptive weakness we have seen during this quarter? And by when do you expect the revenues from these two verticals to start stabilizing, from a growth perspective? And is this something which is likely to overshadow overall company growth over the next 1 to 2 quarters?
Right. So, hi Mukul. So let me start by addressing the second part of your question first, right? So last quarter also, we had indicated that there will be short-term blips due to economic conditions, even though in medium to long-term secular demand scenarios are positive. So we still maintain that view. And then we see signs of softness due to macroeconomic conditions in certain industries and around certain types of spending, largely discretionary spending. We are keeping close watch over this, and we are staying very close to our clients. Now, having said that, the areas where we made investments, such as engineering, data, platforms, is bearing fruits, driving strong, and we continue to drive thrust and see results. Right? Now overall, right, if you look at what's happening in high-tech manufacturing, we will see furloughs in this holiday quarter, and the furloughs will be in line with what we have seen in the previous years, right? So that's high-tech manufacturing and consumer services largely, but overall, from our overall portfolio, we will see furloughs and we will see impact of that in the holiday quarter. Having said that, as we go forward and as the economy stabilizes, as the spend from our clients stabilizes, and as discretionary spend comes back, either the last quarter of this fiscal or in the following quarter or two of the following fiscal, right? We will see these two verticals come back on track. We believe that our banking financial services vertical and banking financial services and insurance vertical will continue to thrive in the current environment because the current environment is conducive and all the investments that we made in the vertical are bearing very strong fruits, right? The last thing I would say is that we are not entirely dependent on what's happening with the economy and its impact on high-tech manufacturing and consumer services vertical. We are continuing to drive thrust in especially areas which impact the core of our clients by providing services and by increasing pipeline. And as we speak, we see green shoots of that thrust which will pay us back over the course of next couple of quarters.
Sure. And also, just continuing on this, improvement in the BFS space, can you just share your thoughts on the use of cash which you have right now? BFS has now grown to be your second largest vertical after you acquired M3BI. Are there areas where you are looking to deploy cash to further lower your exposure to the declining high-tech space and maybe grow a particular sub-vertical within BFS or enter a new area of focus for clients?
Right. So Mukul, we will continue to double down on BFSI. We made strong investments. The investments are bearing very good fruits. The core organic business of BFSI as well as the benefits that we got from the M3BI acquisition. And both of these engines are firing very well. And as we see right now, we see that trend not diminish. It will continue. As we look forward, and as you rightly said, right, that we are sitting on a sizable pile of cash, 162.1 million, after paying off, the variable comp and dividend, right? So after that, we're still sitting on sizable. We are constantly also evaluating opportunities to expand inorganically, and our approach towards that continues to be that we will do tuck-in type acquisitions. And we are evaluating that space, including right now, very seriously, and in areas that bring us capability, skill, market access, and also, supports us from the areas of business that are seeing momentum. The areas where we see market spend increasing over a period of time, and the areas where market trend continues to be positive. So that we are constantly evaluating, Mukul.
Thank you. That's all from my side. I'll get back into the queue.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Samir Dosani from ICICI Prudential Asset Management. Please go ahead.
Thanks for the opportunity. So, Ajay, you mentioned, and we have invested a lot in the freshers program, and we have hired around 1,000 freshers. Can you share some details around, this was in Q4, right? So, can you share some details around what is the number of freshers that you have hired in last 3 quarters, and how much of them have been deployed till date? And if you can just speak about how much and what is the deployment strategy going to be, and how this will help our margins. You can just quantify that also. Thanks.
Sure. So Samir, we had completely revamped our fresher program 4 quarters back. Okay. Now, in the second half of FY22, we hired over 1,000 freshers. In the first half of FY23, we have hired more than 450 freshers, right? It is one of the strongest programs that we have put in place, and we put, like I mentioned in my transcript, right, that the kind of program, the learning and development, as well as the gating program that we have put in place has been a strong success. And what we now see, especially in this quarter, is the fresher deployment significantly rising, the acceptability of freshers by our clients significantly go up, and overall billability substantially increasing. So it has been a very successful program for us, and we will continue to drive this program to support our growth as well as to reduce dependency on the lateral market.
How many freshers will be deployed from this 1450 freshers that you would have hired in last, from H2 onwards?
Yeah. So, Samir, we don't disclose the exact numbers, but I will tell you that from the H2, a sizable population of the freshers has been deployed, and we are tracking to our targets. And it's one of the reasons why we were assisted from a pyramid optimization perspective, and we got benefits on our overall gross margin. So despite 320 basis points worth of wage hikes, the actual impact on gross margin and EBITDA was reduced on a big part because of the fresher hiring program. And we will continue to track that. The results are very encouraging, is what I can share with you.
Okay. Okay. And, as you mentioned about the margins that these margins have bottomed out. What do you think, retail, these three segments that we have seen pressure on, they have also bottomed out? You won't see much decline from here. Maybe there can be some softness, but decline essentially has been arrested. What do you think about that? Thanks.
So, and if I may just clarify, are you talking about revenue?
Revenue, from revenue point of view.
Right.
Revenue point of view.
Right. See the macro softness that we have seen, and the impact of that in certain segments of industry that we serve, that will continue in the short term, right? And then we've got the holiday quarter with furloughs coming up. So we will see some softness in that, but there are two factors. One is that we are very sure, or we are very certain that the long-term secular demand is going to continue to rise. And the turnaround will happen either, 2 quarters out or 3 quarters out, soon as the new baseline is established. And that is going to favorably impact us for both these verticals, STM and consumer services. Having said that, we are not obviously waiting for the economic turnaround to happen. We put some major sales motions in place, and the pipeline in these two verticals is beginning to look quite healthy, right? So the short-term softness we will look to offset with direct growth in our business momentum, as well as turnaround in economy and the improvement in discretionary spend by our clients.
So just to clarify, softness would mean a lower growth or no growth, or do you think there could be some decline also? That is what I was looking for.
Yeah. Sameer, so we don't, guide. So which is why I gave you a qualitative commentary in terms of what's happening in the economy, impact of it, on our business, without getting into providing specific guidance.
Okay. Okay. Thanks.
Thank you. Next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah. Hi, good morning. Thanks for the opportunity. Actually, 2 questions. So one is on the, if you could give some color on insurance. So I think one of your larger peers basically mentioned that there are headwinds on the PNC side of insurance and a lot of weakness. I just wanted your thoughts on how would our exposure to PNCV within the insurance vertical, and how are you seeing the broad demand trends there, both on a near-term and medium-term basis? The second is, it looks like the top client bucket has done quite okay. It's actually grown. I just wanted to understand, not the top client specifically, the top 5 is what I meant. So which vertical really sort of has pushed that? Is it a banking or something on the emerging side? And finally, if you could give us some color on the emerging vertical side as to what all are there within that, and which sort of sectors within that is really driving the growth.
Right. So Nitin, hi. Let me give just the highlight, and then I'll request Nachi Mitra, who is Global Head of Banking, Financial Services and Insurance for us, to give you additional color. So insurance business for us continues to be strong, right? We grew 3.9% quarter-on-quarter sequential and 16.6% year-on-year. So that continues to be strong. And the way we have divided our book into 3 parts, all the 3 parts are firing. And I would actually request Nachi to give you a view of what is going on, and then I'll answer your questions on top client bucket as well as emerging vertical. Nachi?
Thank you, Ajay. And thanks, Nitin, for asking the question. From a broad trends perspective, we are seeing pretty good traction. We specialize in PNC, right? And we specialize in one of the primary software being used in the PNC industry, and we don't see any slowdown. In fact, more and more clients in that segment are moving to cloud, so we see a lot of opportunities in that. We see a lot of clients wanting to move to digital. We see traction in that. So overall, what we also are noticing from an insurance standpoint is that whenever the clients want to optimize their budget, that also is an opportunity for us to be very creative. And that's when we are also called to the table, just not when they do transformation programs. So we are on both sides. The run the business and change the business. They see us as very valuable partners. And it has taken some time to get there, but I think we have established a name for ourselves, and we have a very strong capability right now to have that kind of traction with our clients. There was a second part of question within I missed. If you can just repeat, and also let me know if my answer kind of addressed your question.
Yeah. So just incrementally, Nachiket, is see, historically the insurance business has been a little volatile. I think as those guidewire projects get over, the revenue comes off, and then it's off sort of weak for some time, and then there's a spike. So just wanted your thoughts on the pipeline and how comfortable you're in terms of being able to sustain growth rates here, or do you expect it to continue to be sort of lumpy, right? Because you need a steady flow of business to maintain consistent growth here. So what is it that you're doing in this business to sort of reduce the lumpiness and have a little more consistent kind of flow of growth?
Yeah, thank you, Nitin. I think you're spot on in terms of the concern that you raised. Earlier we would be very project focused in guidewire implementation, and as soon as an implementation would be over, we would be actually looking at a cliff. What we are trying to do very actively now, Nitin, is we just don't do implementation. How do you support the client after the implementation, right? So which gets into more annuity-based revenue model. That's number one. Secondly, we are also trying to change the mix of our clients. Having clients who are very, very small, to clients who are mid and Fortune 1000 or Fortune 500, where they have a wider array of needs, right? And then the third part of the equation is with them. Based on this, relationship that we have, every client has an infrastructure requirement. Every client has a data requirement. It's just not guidewire. So one of the key messages is we will do your guideware implementation and then support it as well. Secondly, we are more than guideware. For the rest of the 98% of the organization, we do data, we do experience, we do infrastructure. And recently we have had some significant wins in new areas. So we are opening up new frontiers in the insurance domain. And then we are also trying to diversify as much as possible into other segments of insurance. We are having very active conversations in life and annuity as well. So overall, I think we have been able to buffet the insurance business from the vagaries of the peaks and the valleys. And I think we are very well geared up to have a very strong business going forward.
Right.
Does that answer your question, Nitin?
Yeah, it does. It does. Thank you so much.
Yeah, thank you.
Yeah. Thanks, Nachi. And Nitin, so your second question on top client buckets, right? It has grown. Scale of 2 cities. Part of the top clients bucket has softness. Another part of the top 5 clients bucket has performed extremely well. Net, we have done extremely well in the top 5 client bucket. In terms of emerging verticals, again, done very well. It's the vertical that runs smart cities, health tech, etc., right? And it has done very well. And for that, if I can request Harjot to provide some additional color.
Sure, Ajay. Thank you. So, Nitin, in terms of the emerging vertical, as Ajay mentioned, we are seeing the growth. We've entered these verticals and opened new logos in the last 2 years with large deals. So they continue to sustain, and we are growing those relationships as well. And these were signed with large customers which have a significant headroom for expansion as well. So we are encouraged with what we see in the pipeline for emerging, as well as the recent deal wins we have in the emerging vertical.
Sure, thank you. That's helpful. So just one thing on the second question was that what I was asking was which within those top 5, which vertical actually contributed to the growth? Is it banking? Is it a banking customer? What really sort of drove? What are the positives and negatives from a vertical perspective on the top 5?
Yeah, so Nitin, surprisingly, it was across, so not just banking, but it was supported by other verticals as well. What I can share with you is the part of the top 5 that grew was across and outside of banking as well. So yes, there was a banking involvement in that growth, but there was non-banking as well.
Sure, that's helpful. Thank you so much and all the best.
Thank you.
Thank you. Next question is from the line of Amit Chandra from HDFC Securities. Please go ahead.
Yeah, thank you, sir. So thanks for the opportunity. So my question is on the margin trajectory. So you mentioned that the margins have bottomed out, and earlier we mentioned that we aspire to reach mid-teens by second quarter of next year. So are we on track to achieve that? And also in terms of the wage hikes that we have provided this year, is it higher than what we have given last year, or is it in line with like what we have planned earlier?
So sure, Amit, I would actually defer that question to Sachin. Sachin, can you take that question?
Sure, Ajay. Thank you. So Amit, obviously, this particular quarter, we had 320 basis point impact of wages against 250 basis points impact which we had last year, same quarter. Now, as we discussed during the annual investor conference as well, there are 6 tracks which we have put in place, and each of us are working very judiciously in executing the plans which you have put under each of these plans, under each of these tracks. Now, given that the success which we have seen in Q2, that gives us fair confidence that we might have actually bottomed out as far as margins are concerned in Q2. And as we discussed, our aspiration to be mid-teens by next year Q2 continues to be there, and every work is going in that direction. So I think we are currently tracking to hit mid-teens by Q2 of next year.
Okay. And sir, on followers.
To your other question, Amit, the wage hike that we have given this year is unprecedented. It is higher than what we have given at least for the last 10 years, if not longer. And that was primarily because, if you recall, until last quarter, our LTM, last 12-month attrition was 28-point-some%, right? 28.1%. And we just decided to take the bull by the horns. We gave a very substantial hike. Its impact on margin was 320 basis points. And we see a very positive impact of that on the attrition rates for this quarter, for Q2. So very quick answer to that part of your question.
Okay. And so on the incremental growth over the last like 2-3 quarters, we have been seeing that emerging vertical, and also from the services perspective, cloud and infra, that has been actually going pretty well for us. So it is fair to assume that these contracts are largely on-site contracts, or the margins in these contracts are fairly lower than what the company level average is. So that's why the impact on the margins is seen apart from the wage hike that we have given. So these contracts are fairly like low margin contracts, and also in terms of the TCV wins that we are seeing, if you can provide some clarity on what was the renewals versus net new, and also in terms of the new deals which we are winning, how is the offshore component in it, and are we seeing some pricing benefits in these deals?
Sure. So Amit, so first of all is that if you see the services that are firing really well, which is advanced engineering services that grew for us quarter on quarter over 6%, and data engineering services that quarter on quarter grew for us 16.8%. Actually, advanced engineering 7.4%. Sorry. So these are strong service lines, and they attract very good commercials. Okay, so this we feel pretty good about and confident about that this growth is, if anything, margin. It's very clearly margin accretive. Now, in terms of the deals we have won, with the exception of maybe one deal, most of these are global deals, which means they have an on-site component and an offshore component, right? And then both, given that we are tracking our target margin profiles, right? So these are not margin dilutive. I just wanted to, give very clear guidance to you in terms of, very clear data points to you in terms of what's happening with our deal wins and its impact on margins. And the last question that you had, this time, the order book has been 141.8 million, which is a little over 13.5% growth over the previous quarter. So the order book has been healthy, and the order book between new and renewals is 40/60.
Okay, sir. Thank you, and all the best for the future.
Thank you.
Thank you. Next question is from the line of Amit Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. So my name is Sandeep Shah, not Amit Shah. Just clarity. The first question is, I think, when do you expect well-balanced growth across verticals? Because BFSI has been doing a heavy lifting for so many quarters. So on a high growth base, the growth may burn out going forward, or you believe BFSI may continue to do well, and that has helped us in terms of seeing the organizational level growth to continue, because we still expect the affected vertical of high-tech manufacturing consumer to remain soft, at least in the near term.
So, hi Sandeep. For, I would say, all parts of our business, be it the 3 verticals or the 5 service lines, what we have endeavored to do is to put grassroots strength, both in terms of our capability as well as in terms of our go-to-markets and the kind of projects that we are addressing. What I can say confidently is that BFSI, the engine that we have created, and what you also heard from Nachi in terms of specifically what's happening with insurance, this is a very resilient engine, right? And I think this will continue to do very well. I don't see any issues, in the near term or far term with BFSI. What will happen is, what we are hoping is that as the industry headwinds stabilize, right, that we go back to, driving our strengths in the other 2 verticals. If you saw what we did last year with both high-tech manufacturing and consumer services, we had pretty spectacular years, right? And then we got hit by this economic headwinds, which particularly affected the segment that we address, the customer segment and the industry segment, sub-segments that we address in these 2 verticals. And we are putting in place sales motions as well as capability motions that will make us more resilient. So I also feel confident that these are short-term issues and that in the medium to long term, we are on the right track.
Okay. Okay. And just in terms of entering into Q3, generally we have furloughs, especially from some of our top clients in the high tech. And what we are hearing from some of the peers this time, there could be abnormal furloughs in some of the clients in high tech and manufacturing. Are we also witnessing the same? And this time the furlough impact in Q3 could be higher than last year, 3Q?
So Sandeep, what I can share with you right now is that, and of course, things change as we go forward. But what I can share with you right now, as we speak, is the furloughs to be in line with what we have seen in the past.
Okay. And on the margin, as I understand, it has bottomed out, but will it have a V-shaped recovery or will have a U-shaped recovery? Because V-shape could be the ask rate to go to aspiration of a mid-teen. Otherwise, U-shape may not help us to go to that kind of an aspiration.
Right. I would defer that question to Sachin, Sandeep.
Yeah. So Sandeep, as I said, that there are tracks which we are running, right from improving the commercials, improving the subcon mix, improving on our recruitment cost, the fresher deployment, which will help me to improve my pyramid. These tracks are currently running, and that gives us confidence that in medium term we will be able to recover our margins. And we are feeling fairly confident that we will be we still have the aspiration of reaching mid-teen margins by next year Q2.
Just a follow-up question. Even in the near term, despite a seasonal weakness and the furlough, one can say there would be an upward bias to the margin because of the 6 tracks which we are working immensely and focusedly.
Yes, Sandeep. That's exactly how we are currently tracking.
Okay. Thank you. All the best.
Thanks, Sandeep. Thanks.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Chirag from Ashika Institutional Equities. Please go ahead.
Hello. Sir, I have 2 questions. In defense technology.
There's a bit of disturbance coming from the line. May I request you to speak through the handset?
Now it's audible?
Yes.
Yeah. So, sir, I have a few questions. You mentioned in your earlier remark that some of Fortune clients deferring their spending. So, as per your conversation with them, when you feel that they will come back to normal in terms of spend, and also in defense technology, other than drone, in which areas we are working?
Yeah. Okay, Chirag. So we see softness largely being driven by global macro conditions, which in turn is largely being driven by what's happening with the inflationary environment and the general compression of margins across the globe in the body corporate, right? And this will play out over the course of next couple of quarters. Now, as the margins get stressed, right, the natural reaction from the industry is to reduce discretionary spend. And, we got impacted because of that, especially in the segments that we serve in high-tech manufacturing and consumer services. This will play out until the inflation situation and the margin situation with the global body corporate stabilizes, right? And that will play out over the course of next 2 to 3 quarters. So that is what we are tracking. And obviously, we have put mechanisms that we are not entirely reliant on this turnaround of margin, and then we put sales motions in place to increase our pipeline elsewhere, right? So that is what I can share, number 1. Number 2 is, on the emerging side, we have big plays in smart cities, in health tech, etc., right? And those will continue to be focus areas for us.
And your strategy with respect to domestic business for next 5 years?
Yeah. So Chirag, good point. We are watching the market very closely, and we will take a decision on that as we see fit into our general overall strategy from a service perspective as well as from a geography perspective, but we are watching that carefully.
Okay, sir. Thank you. Best of luck.
Thank you. Participants, you may press star and one to ask a question. As there are no further questions, I will now hand the conference over to Mr. Ajay Bhudoria for closing comments.
So thank you, ladies and gentlemen, for joining our call today. Really appreciate you taking the time and look forward to connecting with you in the next quarterly call, if not earlier. Thank you very much. Good morning, good afternoon, good evening to all of you.
Thank you very much. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.